Have you noticed that every now and then the financial market gets hit by a collective fever where everyone decides they have discovered the new golden goose? Today, that fever has a name: artificial intelligence. If you open any news site or look at the performance of the stock market, it seems the only way is up. But while the share prices of companies making chips and servers skyrocket, a warning sound is starting to come from the offices of the world's most skeptical economists. The question keeping hardworking people awake at night is not whether artificial intelligence works, but whether the price the market is paying for it makes any mathematical sense. Are you looking at a revolutionary tool or a financial bubble about to burst in the face of whoever arrives last? To understand if the AI bubble will pop, you need to look at where the money is going and how the cycle of euphoria actually works. The logic behind any bubble is always the same. The price of something goes up not because its real value increased, but because people believe they can sell it to someone smarter or greedier for a higher price tomorrow. Heavyweight institutions like Goldman Sachs recently threw a bucket of ice water on this runaway optimism. The technical argument is that tech companies are spending trillions of dollars in infrastructure, buying powerful machines and building massive data centers, but the financial return on that spending is still invisible for most businesses. Imagine a whole city decides to spend its entire budget on pickaxes and shovels because they heard there is gold in a nearby mountain. The hardware stores get rich first, their stocks go up, but if after 2 or 3 years no one finds real gold, the value of those tools plummets and the local economy breaks. In the tech world, chip makers are the tool sellers. If the companies buying this technology cannot turn a smart chat into real profit and massive cost savings, the math simply will not work. You need to understand that AI today is a massive cost before it is a profit. Keeping these models running requires an amount of energy and water for cooling that the world can barely provide. The cost of every question you ask an AI is significantly higher than a standard Google search. If the cost is high and the practical utility for most companies is still limited to summarizing emails or creating images, the market starts to ask, where is the productivity boost that justifies trillions of dollars in market value? Analysts like Jim Cavella warned that unlike the internet or the smartphone, which became cheaper and more accessible quickly, high-end AI remains prohibitively expensive and difficult to implement in traditional sectors like construction, healthcare, and transportation. If the efficiency gain doesn't arrive soon, investors will pull the trigger and sell. Economic history is a cruel teacher that is rarely heard. You might remember the dot-com bubble in the year 2000. Back then, any company that put a .com in its name saw its stock price double. Did the internet change the world? Yes, it changed everything, but that did not stop 90% of those companies from going bust and investors from losing trillions because the valuation was based on promises, not profit. The market tends to overestimate what a technology can do in 2 years and underestimate what it will do in 10. The danger for you today is the herd effect. You look at the meteoric success of a couple of companies and believe the whole sector is safe. But what happens if the next financial reports from these giants show that companies have stopped renting servers because they are not managed to profit from AI? The house of cards begins to wobble. What would be the real consequences for your wallet if this bubble actually burst? The first and most immediate would be a brutal correction in the global stock market. Today, the S&P 500 index is carried by just a handful of tech companies. If these giants drop 20 or 30%, they take the whole market down with them, including the pension funds and retirement savings of millions of workers. This creates what is called a negative wealth effect. When you look at your investment account and see the balance has shrunk, you feel poorer. Even if you don't need the money today, fear takes over and you cut your spending. You stop looking for a new car, you postpone your home renovation, or you cancel your vacation. This cut in spending stalls trade, companies stop hiring, and what was just a market dip turns into a recession in the real economy. An AI bubble burst would also cause a tech winter. The easy money currently funding any idea with AI in its name would vanish overnight. This would lead to mass layoffs in the tech sector, affecting engineers, designers, and data analysts. But the impact doesn't stop there. Since these tech firms are the biggest buyers of commercial real estate and the biggest spenders on advertising, those sectors would feel the blow next. The economy is a web of connections. If a central hub like the tech sector breaks, the vibration is felt even in the small businesses in your town. Unemployment would rise, and the government would have to spend more on aid, increasing national debt and pushing interest rates up, which makes your loans and your credit card even more expensive. Another serious consequence is the energy and infrastructure crisis. Many countries are currently shifting their energy grids and investing billions to meet AI demand. If the bubble bursts and these companies abandon data center projects halfway through, the waste of capital would be colossal. The cost of this useless infrastructure would eventually be passed on to you through fees and taxes, or in the form of an economy that invested in the wrong place. Imagine building a massive highway that leads to nowhere. The cost of the work remains, but the utility is zero. This is the risk of an allocation of capital based on euphoria rather than real market demand. However, you should understand that a bubble bursting does not mean the end of the technology, but a necessary house cleaning. In 2000, many companies disappeared, but Amazon and Google survived and became the pillars of the modern economy. If the AI bubble bursts, the world will see a clear split between those with a solid business model and those just riding the marketing wave. The consequence for the world would be a forced maturing process. The focus would shift from what amazing thing AI can do to how it can be useful and profitable today. This is good for the consumer in the long run, as it forces technology to become cheaper and more efficient. The problem is the social and financial cost of this transition, which is usually paid by those who entered the market at the peak of the euphoria. For the United States and China, currently the only two heavy hitters in this race, a bubble burst would redraw the balance of the entire planet. The economic strength of these nations is tied to digital leadership. If the tech sector takes a tumble, government tax revenue plummets exactly when national debt is at record levels. Without that money coming in, the government struggles to pay the interest on what it owes to its creditors. The direct effect of this is a weakening of the dollar on the global stage. For you, the result is inflation hitting your door harder since your currency is worth less when buying what comes from abroad. The end of this euphoria cycle could shift the focus away from algorithms and accelerate the transfer of economic power to countries that dominate real-world resources like energy, minerals, and food. It is proof that, at the end of the day, no one can eat computer code or power a country with digital promises alone. Logical reasoning shows us that we are in a moment of disconnection. The stock market is on one planet and the real economy is on another. While global GDP grows slowly, tech stocks grow as if we had discovered the cure for all human problems. This math does not add up forever. The financial market is driven by two basic feelings: the greed of making quick money and the fear of losing what you already have. Today, greed is in charge, but fear is a much faster and more violent feeling. If the next report of a major company shows that AI profits are not coming, the herd will run for the exit at the same time, and the door is too small for everyone. Don't forget to subscribe and like the video to support more content like this. For you, the worker and the small investor, the secret to financial security in the coming years is caution. Do not be carried away by promises of easy profit in sectors you do not fully understand. Financial balance does not come from picking the next stock that will change the world, but from protecting what you have already built with your hard work. AI will continue to transform the world, just as the internet did, but that does not guarantee every company in the sector will be a winner. History shows that in gold rushes, those who make the most money are the ones selling the jeans and the pickaxes, not necessarily the ones digging the mountain. The end of the AI bubble would bring a period of instability, but it would also bring the technology down to the factory floor, to the store counter, and to the reality of your life. The focus would shift to real utility. The AI that survives the bubble burst is the one that helps the doctor diagnose better, the engineer build faster, and the worker be more productive. The rest is just market noise. Stay alert to the signals. When interest rates are high and money becomes expensive, the market stops accepting promises of profit 10 years from now and starts demanding profit now. The moment that demand hits the door of the tech sector, we will know who was swimming with clothes on and who was naked. The world you know, where credit was plentiful and technology solved any financial problem on the market, is changing. Physical reality, energy, raw materials, and real profit is back to dictating the rules. The end of the AI bubble would not be the end of artificial intelligence, but the end of the illusion that money can grow forever without real production behind it. Be prepared, diversify your interests, and do not put your entire future on a single tech bet. Popular wisdom says not to put all eggs in one basket, and in the global financial market, that rule has never been more relevant. Trust is changing hands, and you need to be on the side of those who possess real value, not just digital promises.